talking about potentials and understanding how we can make the most of the markets. Go more into Texas. We have been this one series where we'll be talking about choosing stop loss points as well as settling objectives and other position. And so advantages we've been getting this way. Of course, we have been wire racking as profits as much as possible this webinar sessions. So we continue and we hope and make sure that you all are taking the thing because they're actually very helpful and the best trader. Make sure you are inconsistent. So let's get started. Next page. Now, stop this point. In this chapter, we'll be talking very much important thing about choose stop loss and points whenever you place a trade, because these things are very essential when you are getting into a trade. You always need to put a stop loss. Then most traders don't know exactly their stop loss points are supposed to be. So this chapter, we'll be analyzing all of this to them to help them understand exactly where the stop loss point to be. Now, the success of chart-oriented trading is critically dependent on the effective control of losses, because as mentioned, it is not necessary to be right half the time. What is indeed necessary is limiting losses on bad trades sufficiently so that winning trades are substantial enough to return a profit. But then accordingly, we have a precise stop loss liquidation point which should be determined before initiating a trade. An approach would be to enter a good till cancelled stop order. At the same time, trade is implemented. But then, however, it could be determined the stop point anytime the permissible daily limit. Next page, please. So how should stop loss be predetermined? How can we know where it puts? How can we on our charts more deep analysis this now? For example, we assume that a trader decides to buy a stock in figure 9.1, as you can see after the April 1995 upside breakout, where it has remained intact for 5 years. In this case, a protective sell stop should be placed no lower than the lower boundary of the April 1994 to April 1995 trading range. Of such a price will totally transform the chart picture. But some of the technical reference points for placing protective stocks obviously include: one, understanding your entry point, knowing how much profits you're ready to take from it. Then with this, you can be able to understand what stop loss, how much you're willing to risk that trade. All right, next page. Another thing we need to keep putting the concentration at the trading range, which of course is frequently the stop that MBP is close more. Rather, becomes a value signal too deeply into the range, because the stop might be placed somewhere in the zone between the midpoint and the more distant boundary of the range. So sensing that midpoint of the trading range, the near end of the trading range would not be a meaningful stop point for us. Now, another thing to take into consideration are the trend lines, because a sell stop can be placed below an uptrend line, so can be placed a downtrend line. One advantage of this approach is that the penetration of a trend line will usually be one of the in a trend reversal, because the stop points will strongly either be lost or surrendered open profits. However, this attributes to a steep price because trend line penetrations are prone to false signals. And this, of course, is common for trend loss of a bull or a bear market. Quite understand it. Next page, please. You have flags and pennants, stop level indicated by the lower boundary of the flag. And after the upside breakout of the flag, have the penetration of this level, which would imply that a reversal of the current uptrend and require liquidation of the long position. Then we also talk about wide breaking gains, similar to flags and pennants, which after a breakout in one direction, they return to the opposite. Hence, we need to note how the of the one update formed in mid-September after initially trading above this pattern, which led to a major price collapse. Next page, please. Relative highs and relative lows, because if the implied risk is not too great, the most recent relative high or relative low can be used as a stop point. For example, we assume a trader initiated a long position in response to the early January 1998 confirmation of the double bottom shown in figure 9. The nearest technical stop loss points carry excessive risk, because in such cases, traders may opt for a money stop loss dollar amount rather than technical levels. For example, in April 1993, the trader who believed lumber had peaked after the March stop with faced $2,000 risk a contract using the nearest highest stop, waiting for a pullback to reduce risk, or the market might drop for the first. In such scenarios, entering with a money stop may be the best option. Next page, please. Stops should be used not only to limit losses, but also to protect profits. In the case of a long position, the stop should be raised intermittently as the market rises. Similarly, in a declining market, the stop should be lowered as the market declines. This type of stop is called trading stop. If you go next, we illustrate the use of trailing stop. Assume a trader implementing a long position on the November of the September-November trading. Especially the trader plans to liquidate a position, the long position. Thus, the initial stop loss point will be a close below the October low. And in this example, we have a relative low being defined as the lowest low of the past 10 days. Next page, please. Now, following the December rally to new highs, the stop loss reference point will then be raised successively by stop 3 and stop 4. And of course, this will be stopped out on the decline below stop 4 in May, because alternately, a trailing stop could follow a position by a fixed dollar, percentage, or point value. But this technique, however, has the same implications that of the. So it keeps risks at a known level and frees the trader from overly risk stop points, because of course, based on chart patterns, it may also be needed to liquidate a trade when there is no technical reason for doing so. So I should only be changed in order to reduce risk bottom of the move, or at the top if short upon initiating the position, but then cancel the order when the market gets within range. But this type of order has been derisively, albeit properly, referred to as a CIC, cancel if close order, revising the stop to allow greater risk defeats the entire purpose of the stop. Next page, please. So here's a representation of this on the chart to best understand this. We have an example of market where money stop up your operate in 1993 lumber, which had a predictor coming this move as causing ripples on the chart and for as much profits as possible. Next page. Next page. Now, we move to the next topic, which is setting objectives and order position. Exit criteria. Very importantly, one of the best topics in the Forex market. Now, a trade is like the army. Getting in is a lot easier than getting out. But provided the trade is adherent to control principles, we have a losing trade presents lead to ambiguity, that is, liquidation will be indicated by a predetermined stop point. However, the profitable trade presents a problem some of the primary objectives, which are quite important to follow up whenever you're understanding these chart patterns. Next page. Many chart patterns are believed to provide clues regarding the magnitude of the potential price move. For example, we have conventional chart wisdom, which suggests that one price is penetrating the neckline of a head and shoulders formation, and the ensuing price move will at least equal the distance from the top or the bottom of the head to the neckline. As another example, many point and figure chart lists claim that the number of columns that compose a trading range provides an indication of the potential number of boxes in a subsequent trend. So for an explanation of point and figure charting, generally speaking, we have chart patterns that are probably considerably less reliable as indicators of price objectives than as trade signals. Next page, please. Now we talk about measured move, because this method is the essence of simplicity. The underlying premise is that markets will move in approximately equal size price swings. But then if a market rallies 30 cents and then reacts, the implication is that the rally from the reaction low will always approximate 30 cents. And although the measured move concept is so simple that it strains credibility, the approach might be one that offers reasonable guidelines more frequently than one might expect. But then when two or more of these objectives nearly coincide, it tends to enhance the reliability of the price area as an important objective. So we have figure 10.1 with the and number of measured move objectives based on both smaller and broader price swings, denoting the former with a number suffix and the latter with a letter suffix. Because most of these objectives prove to be surprisingly accurate, we understand is that, for example, the initial rally of 211.16 in July to August 94 provided a price objective at
MMI after retracing approximately a point over the next 5 weeks. The market rallied 2,916 in October and November, only 2,916 away from that. Next page. So since price swings often span several futures contracts, it is useful to apply the measured move technique to long-term price charts that link several contracts. Generally speaking, continuous futures charts are more appropriate than the nearest futures chart for measured move analysis because, as was noted in Chapter 2, continuous futures accurately reflect price swings, and whereas nearest futures do not. Okay, next page. Now, the diagram below shows the application of the measured move approach to a continuous futures chart. And this chart, of course, reflects a multitude of surprisingly accurately measured move targets and the measured move objective implied by the initial downswing from the January 94 market top. Also exactly coincided with the actual March 94 relative low, although the measured move objective implied by the February early made it look sure for an entry. Next page. Now, we are understanding that it proved a bit wide of the actual May low because the measured move objective indicated by the entire decline from the January 94 top to the March relative low was near perfect in projecting the actual May low. Then particularly striking was the fact that the very major measured move objective implied by the entire decline from the January 94 top to the May 94 low almost exactly projected the number 94, November 94 bottom. Moreover, the September early October downswing provided a similar reinforcing measured move objective because together these two measured move objectives provided strong evidence that the market was near a major bottom in late November 94, as was seen in this chart. Example, there often will be more than one measured move objective for the same projected low or highs, and this will of course occur when there is more than one relevant price swing for deriving a measured move objective. So when two or more of these objectives nearly coincide, it tends to enhance the reliability of the projected price area as an important target zone. And then figure 10.3 provides a perfect example of multiple near coinciding measured move price targets. As we can see, the measured move objective implied by the late March to late May advance and the June upswing, and then the late June to July up move, will approximately coincide just below the actual market top formed in August. Next page, please. That explains everything we have been talking about. A chart concentration of measured move targets, October 94 crude oil, pushing gradually to the upside, and we're expecting a move up to actually get the clear direction of where the market is heading to. Next page, please. Support and resistance levels. Points near support and resistance levels provide a reasonable choice for settling initial objectives on short positions. But then, for example, the indicated objective zone in the figure 10.4 is all based on support anticipated in the area of two prior relative ties. Similarly, prices near resistance level can be used for settling initial objectives on long positions. For example, the indicated objective level in figure 10.5 was based on resistance implied by a prior significant high. But then generally speaking, we have support and resistance levels that usually represent only temporary rather than major objectives. Consequently, in using this approach, it is advisable to seek to re-enter the position at a better price if a reaction actually does develop. Next page. So here explains everything we just talked about. We can see a chart of a downside objective as support zone and the downside objective zone based on support implied by two prior relative highs. And of course, this can be an upside objective at resistance level based on prior significant high, GTE curve chart created with TradeStation, and much more to understand from this. Next page, please. We have the overbought and the oversold indicators. The overbought and oversold indicators are various technical measures, sometimes referred to as oscillators, intended to reflect when prices have risen or fallen too sharply and are then vulnerable to a reaction. So these indicators were described in detail, and that the choice of specific overbought and oversold boundaries is a subjective one, because, for example, instead of 70 and 30, one might use 75 and 25 or 80 and 20. And the more extreme the selected threshold levels, the closer the overbought and oversold signals will be to market turning points. But the greater the number of such points that will be missed, that is, reaches an oversold condition that can be viewed as a signal to liquidate short positions. The sell arrows in figure 10.6 denote point at which the RSI crosses above 70, that is, reaches an overbought condition that can be viewed as a signal to liquidate long positions. Next page. So on balance, the overbought and the oversold signals in the figure above, provided reasonable good position liquidation signals, and this example hints at both the attributes and the drawbacks of using overbought oversold indicators as liquidation signals. Now, the approach will usually work well when the market is in a trading range, but will fail miserably during strong trending phases. And the overbought oversold signals work on balance because the illustrated market remains predominantly in a trading range pattern, which illustrates the application of RSI over overbought oversold signals in a market dominated by a trend. And again, why the signals in the October 95 to January 96 broad trading range are useful, the repeated sell signals in the preceding 9-month rally highlight the limitations of this technique in a trending market. Next page, please. So here's a chart that replicates everything we just talked about. You can have some time to check it through. Next page, please. We talk about contrary opinions because sometimes even the nearest technical stop loss points carry excessive risk. And in such cases, traders may opt for a money stop, a stop loss based on a fixed dollar amount, rather than technical levels. For example, in April 93, we have a trader who believed lumber had peaked after the March drop, would face a $15,000 risk per contract using the nearest high as a stop, waiting for a pullback, which could reduce risk, but the market might drop further first. In such scenarios, entering with a money stop may be the best option. Then now we talk about trading stops. The use of trading stops may be among the least glamorous but most sensible methods of determining a trade exit point, although one will never sell the high or buy the low using this method because the approach comes closest to the ideal of permitting a profitable trade to run its course, because trailing stops were detailed in chapter 9. We also talk about change of market opinion, which is another approach with very little flash, but lots of common sense. In this case, the trader sets no predetermined objectives at all, but rather maintains the position until market opinion changes to at least neutral. Next page, please. So that's a wrap on today's today's program. We'll keep talking next week, and we discuss more and more brighter topics to help foster your trading ability and help give you success profits, back-to-back profits. And we wish you a happy weekend. See you again next week.